Great. Hi, Cyril. It's
Hi,
James
James.
here. Great that you can join us. Welcome. Uh, and welcome to the audience. I have no idea how many people we have attending today, but welcome to them too. And I'm just going to say, basically, a big welcome to this Treasury Lab number 10 session on hybrid financing. From wherever you are, it is the fourth day of this year's ACT annual conference, and I hope you've been able to enjoy some of the excellent sessions that have already occurred. Before we get going, let's just talk about some housekeeping. We're going to do a poll early on of the audience prior to Cyril's presentation, and you can find the poll button for this next to the Q&A box in the toolbar at the bottom of your screen. There will be a Q&A at the end, which is the bulk of the session. Please submit your questions via the Q&A box just above the session window if you are joining us via the web link. If you're joining on the app, the Q&A button is located at the bottom left. All questions are kept anonymous. Recording. This session is being recorded and will be made available for rewatch on the event portal shortly after it finishes. And there's a discussion forum, which is a virtual discussion forum, which allows you to share your comments, ideas, or takeaways about the session with speakers and fellow attendees. Right, so let's make some introductions now. My name is James Leather, and I have worked in corporate treasury for 20 years. I am currently the interim treasury manager for Interserve, which is a distressed outsourcing and construction company, and have been providing my services in an interim and advisory capacity since 2016. Prior to this, I held a senior treasury role for 4 years with UGL, also an outsourcing and construction company that was in distress in Australia, and I was with British American Tobacco for 10 years. The theme for the conference this year is Balancing Risk, Championing Sustainable Growth. And when I was asked to do this session, I initially typed in hybrid financing into Google, and I was relieved to find a connecting theme, which was the financing of hybrid automobiles. However, I am relieved to have Cyril here today, Cyril Fleck-Chatelain, Head of Liability Management and Hybrid Capital and Capital Market Solutions at Mitsubishi UFJ Financial Group, or MUFG, as perhaps we're more familiar with. He's with us today, and he's going to tell us what hybrid financing is really about. As we will see, hybrid financing has grown rapidly in recent times, and as well as explaining what this is, Cyril is going to explain to us why it has grown in popularity and help treasurers understand if it is right for their organizations and how they can go about issuing it. So Cyril, welcome. It is really great to have you here. Cyril, I'm just going to introduce you briefly, but Cyril started work in the financial institution sector in 2006, helping regulated financial institutions raise finance via hybrids to enable them to meet their capital requirements. But since 2016, he has applied his knowledge and skills to the non-FI sector with MUFG as head of liability management and hybrid capital and capital market solutions based out of Paris, I believe. To date, Cyril has executed over 100 public liability management transactions, including BP's recent tender offer in September 2020, which was the largest corporate bond buyback to date in Europe. MUFG has been ranked in the top 10 in the past 2 years in liability management globally, and number 2 in corporate hybrids for the past 3 years. Cyril, that is really impressive. So I am very much looking forward to your presentation and finding out more about this growing subject. In terms of format for the session, everybody, Cyril is going to make a short presentation of 10 minutes before the audience is invited to ask questions, which I will then discuss with Cyril. But before we start, I would like to do a quick poll to help us understand our audience. So a message to the audience: you can find the poll button next to the Q&A box in the toolbar at the bottom of your screen. And the poll question is your organization funded by hybrid capital already, or is it actively considering it? If the answer to either of these questions is yes, then please answer yes right now. Otherwise, obviously, no. Poll results: no. 75% of people say no, yes says 25%. So Cyril, I think that gives us a good indication that the majority of people don't have your level of expertise, perhaps, but not necessarily. They may have done it in the past, but I think it's a good assumption, and I think it's a helpful basis for us to go forward on. Is that all right, Cyril?
Okay, yeah, thanks, James, for the intro.
Great, great,
thanks
no
for
worries.
taking time to connect to the session. I've really tried to condense this topic into 4 key slides, which you should have popping up on your screens. Hybrids, I think, before I get into the specifics, is a very kind of broad term, and I think it's important to just distinguish within the hybrids what we're talking about, because, I mean, as James said, when you just look at hybrid cars, there's a broad range of hybrid cars you can look at yourself, right? There's the ones that there's the ones that run without any sort of charging device. So I guess it's a bit like that with hybrid bonds, because you clearly have hybrids which are issued by financial institutions. You have hybrids issued by corporates. You have hybrids issued by insurance companies. They all have a different flavor. The hybrids we're going to be talking about today are the ones that are issued by corporates, mainly for rating agency purposes. So they are, rated companies issuing hybrids to protect their balance. Right? It's not for regulatory purposes like you would typically see for banks. So that's the clear distinction I want to make. And I guess the way you structure these hybrids are really by, rating agency criteria when it comes to this product, right? So it's a subset of a hybrid population, which is pretty broad. If we move to the next page, I've outlined, who have been the key issuers here in terms of hybrids, and I have a small kind of key items which you typically see on these hybrid structures. But maybe just before I get into the details here, I think what's clear to me is that an instrument kind of combines both, equity-like features with, debt mechanics to sense, which makes it particularly interesting. I think that's where the name really comes from. It's that, from an accounting perspective, it is equity, as long as you issue a bond, it is considered equity under IFRS. But when it comes to the cash flows, it feels very much like a bond. It pays coupons, a redemption profile, which is fairly, clearly defined. So it has a lot of, the features we see on fixed income instruments. So your investor base who's buying these instruments is effectively, the ones that are buying your senior bonds in effect. So that's kind of the high level, details around hybrids. Who has been issuing hybrids? Well, you can see from the little table at the bottom, we have, the blue chip names, autos, oil and gas companies, pretty present in this space. So really just a very broad range of sectors, and obviously, large companies with pretty sizable balance sheets who have come to this hybrid universe. The hybrid instrument itself, I don't think it's particularly complex. As I said, it's really just like a bond to a certain extent. The features I highlighted in green here on the right table. To qualify as a hybrid, I think what you need to kind of mind for from a structuring perspective is it has to be subordinated. Usually it ranks just below equity. It's a rated instrument, and again, typically rating agencies would notch it down by 2 notches from where your senior rating would come out at. It can be structured as a perpetual, instrument, which would then qualify for, 100% equity under IFRS, or it can be long dated, which again then means that it's more likely to qualify as debt from an accounting perspective. The way rating agencies look at this is slightly different. Obviously, they would rate this. They would qualify the hybrid as 50% equity, 50% debt. So they take a more nuanced view. The other features, which are important here is that it has to have a minimum, 5 years before it has its first call date. So that's something, structure, either a non-call 5 or longer. That's kind of the standard template. And then you have some, more commercial terms, like, for example, step-ups, which are very, very low. You would see, the bonds step up maybe by 25 basis points in year 10, and somewhat, higher step-ups further. But usually these step-ups don't exceed, 100 basis points on a cumulative basis over a certain time. The other interesting feature on I think is another key element in qualifying as such, is that the coupons are not must pay. So you have some, discretion around coupons, which you don't have on senior bonds, obviously. The way investors get comfortable with the coupon discretion, which you have on these bonds, is that there's a mechanism which is called a dividend pusher, which in effect means that the company that issues hybrids, as long as they're paying dividends, there's a legal obligation to pay coupons, which, makes investors think, there's some sort of protection there when it comes to coupon payments. So we haven't any circumstances where, companies, even when they go into a more distressed state, actually end up not paying coupons. So that's clearly to keep in mind. If we move on to the next page, I think James raised this, when we were doing the intro. Cyril, how has COVID affected hybrid issuance? And I said, well, yeah, it's a good question. I looked at the chart, and you can see for June, actually, as I was looking at this chart again, I realized it actually blew off the scale of my chart. So it's 17 billion of hybrid issuance. That's probably the run rate we see in 1 year. The average rate of hybrid issuance tends to be around, 20 of issuance. I think we got close to that in just 1 month in June, and it's been pretty busy ever since. So quite a tally. Now, why is that, and who has been issuing? I think, if you look at the little pie charts on the right here, what you'll see is that, from 2019 to 2020, issuance has shifted. So the sectors that have been most active here, clearly at bottom right, have been the oil and gas sector. If you look at this year's volumes, it's almost 50% of issuance coming from that sector. Obviously, BP, one of the largest trades, this issued 12 billion in one go, makes up for a bulk of that. And in terms of issuance rationale, it's not always black and white, but what we can clearly see is that it's been mainly about, shoring up your balance sheet and, defending your rating in a sense, as we're going through this difficult cycle, which you could argue is just a temporary moment of stress in the financial structure of a company, right? Because we don't know how long it take before, the COVID situation resolves, but it's maybe just a matter of 2 to 3 years before companies operate, under normal circumstances. So the hybrid product, in that sense, seems like a temporary balance sheet fix, which works pretty well and may just be more cost effective and more elegant than rating, which dilutes your shareholders and is a more permanent kind of balance sheet measure, which maybe doesn't feel quite adapted to the current context. So that's really one of the key features of hybrids. This time around, I think it's come out as being a very interesting product for corporates, and we've seen a number of them come to this asset class for the first time. If we move on to the next page. I've highlighted a few names here which have been active in the space at the bottom. So you can see, on the bottom left, the likes of Bayer, Danone, so more, consumer names, oil and gas names, real estate companies, obviously levered companies which benefit from corporate hybrids. but also telcos and utilities have been really active in this space. And I think it's important to me that, to say that this asset class has gone through some sort of a revolution over the last couple of years, going from something which you used to use, mainly for options, or, when you had a heavy investment phase, you would rely on hybrids, to something which is much more dynamic these days. I see core issuing hybrids to pay scrip dividends, or to pay dividends as such, as a WACC optimization tool, and that's clearly come about because rating agencies have relaxed their criteria. Investors have become more and more familiar with the product. The overall cost of hybrids in the context of central banks buying corporate bonds has come down quite a bit. So it's become a really interesting tool also from a cost of capital perspective, which is what we've experienced in the last couple of years, I guess. Move to the last slide. Next slide here, which highlights the point I was making earlier, cost of capital consideration. What we can see here is that in theory, raising equity and debt, if this was a perfect kind of world, you would be indifferent, obviously, over just going 1 billion of debt, 1 billion equity should cost the same as 2 billion of hybrids. The fact is that it doesn't actually work that way, because we can see that hybrids come out substantially cheaper. So there is a real arbitrage here for corporates to issue hybrids, as you can see in this little chart, because it does a fixed income product. And the cost of hybrids today are artificially low, because I would say senior debt is artificially low with all the central support, which makes the hybrid product a cheap way of raising equity, or call it synthetic equity. And if you layer in the tax benefit from raising hybrids, it is even cheaper than what we've illustrated here on this chart. So you have considerable cost savings which come with such a product. On to my last slide. I think I've highlighted this earlier in terms of volumes. What we saw in the past is that the run rates kept at roughly 20 billion per annum, 30 when we look at 2014 when hybrids really kicked off. But it was a slow growth up until recently. I would say this was mainly linked to the fact that there was some reticence from corporates to issue hybrids, because they were not really comfortable with the rating agency methodology. Okay, so what has happened in 2018 is that mainly S&P changed the way they look at hybrids. They adapt, or they modified their methodology to make it much more user-friendly for corporates to issue this product. That has then, combined with the fact this instrument became cheaper and cheaper, really raised the issuance volumes, as you can see on the chart here, where we've now reached a run rate of roughly 220 billion of outstanding hybrids. So I'd say hybrids, as such, have become pretty main, and we can really consider them almost like senior bond issuance, which is fast access for corporates. So it's not such a long lead time to raise a corporate hybrid as you would see, for example, on raising equity. And that's really made it, a pretty user-friendly instrument for some of these large corporates who have come to the market recently in this format. The market's mainly dominated by euro issuance. I think that's kind of the bulk of the volumes which we're seeing these days come in euros, but we do see occasionally, as one example, issuers, spread their wings, issue in dollars and in sterling to diversify and source larger volumes from the market. Geographical footprint of hybrids, I would say, you can see it here on the top right. It's pretty mixed. Obviously, again, UK seems to make up for the bulk this year because of the BP trade, which is was a very, very large transaction. But I'd say it's pretty mixed. We have a very long list of French corporates who have been issuing hybrids, as you saw on the first page, the likes of Total or EDF. You have there, the largest corporate hybrid issuer today is Volkswagen, with over 11 billion of hybrids outstanding. But you also have, telcos like Tele or Vodafone who are really big in hybrids. So it's really pretty diverse in terms of geographies as well. So I'll just I don't know, maybe took up too much time and open for questions if that's
it's coming through
that's
here.
Okay.
And if you want to, do you want to say something final on your slides before we move into the questions? No,
I think that's it, James. I think now is a good time to maybe shift into Q&A, if that's okay.
Great. Well, I've got some questions coming through, and a message to the audience is please keep asking, because I find this a very interesting area, and it's certainly moved on from my understanding of it. But let's move back to your first slide, Cyril, and I've got an audience question, and I've got my own, but I think I can merge it. The audience question is: are hybrids a recent innovation? And if I just sort of combine it with my own experience, this may just help you define the full spectrum of what it is, and perhaps where you specialize as well, and the differences. But my own experience is working in Australia in an infrastructure project. There was $2 billion Australian dollars of subordinated debt provided by the Commonwealth Government of Australia, which actually enabled that infrastructure project to get off the ground. I've also experienced working in a highly leveraged private equity financed outfit that used first, second, and third lien tiers of debt. And then where I am right now, which is a distressed company, has senior debt, but then it's had to raise further finance, which is classified as super senior and super senior. So I just asking, along with that question about, is it a recent innovation? Can you just describe where these things fit into the spectrum of hybrid capital and what your specialism is?
Yeah, sure. So as I said earlier, I think the term hybrid is pretty wide. If you ask me, since when do hybrids exist, I would actually go and say, hybrids in the strict sense, a very long time, because banks issued hybrids for regulatory purposes, right? And what we saw during the financial crisis is hybrids, call them, subordinated debt for banks, failed to protect these banks at times of stress. So that's when Basel III came along and reinvented the hybrid we know as of today. The CoCos, the AT1s we see from banks. These are hybrids, and these have been right because they had to be more resilient, more adapted, more fit for purpose in this context. Now, the hybrids here, we're looking at really a rating agency creation, nothing to do with the regulatory capital. And if you have to go back to 2013, I would think, when rating agencies came concept, right? But I'd say it's mainly was created on the back of what we already knew about hybrids from financial sector. And as they created this hybrid instrument, which again is very unique because it's 50% equity, 50% debt. It's not binary as under the accounting rules. That's the creation of 2013, and then it went through a couple of turns, right? So it kept on moving the goalposts. Yeah. And I think the key milestone here is I'd say 2015 when S&P came out with their criteria, and as of that day, I think we have what I consider kind of the blueprint for corporate hybrids. So fairly recent, you could argue, and recent changes in 2018 have again raised some eyebrows because corporate and investors alike do have the feeling that this is an asset class which is fairly volatile in a way. Not ideal, clearly, because you want something stable. But I think the last turn of call it, rating methodology change has created a fairly stable situation, which I think most corporates and investors are very comfortable under as of today.
That's very interesting. So you're saying that what would you say is the most common type of hybrid issuance at the moment, Cyril?
In terms of volumes, it's clearly coming from the banking sector.
Okay.
Regulatory.
And in terms of the corporates?
And in terms of the corporates, it's really what we see today. It's a perpetual bond with a discretionary coupon, and it qualifies for 50% equity, 50% debt under Moody's, Fitch, and S&P.
And what's it qualifying as on the balance sheet from accounting?
It would be 100% equity if it's perpetual.
Right.
And if it's long dated, let's say 60 years on or longer, it would be debt.
And are you seeing most corporates choosing equity?
Yeah, correct. I think what you realize is that there's a strong bias to accounting it as equity. So most corporates we see today are perpetual. The one reason why some corporates issued hybrids is for tax reasons, really, because as a dated instrument, having this instrument debt accounted, it usually goes hand in hand with the tax payment. So these instruments would then be, would have the coupons being tax deductible. Now that's typically the case also for perpetuals, but in some jurisdictions it's more complicated than others, which is why, let's say, for example, some of the German hybrids we've seen tend to be dated instruments. The tax deductibility with the fairly high coupons that come with hybrids is a nice feature to have, and very often outweighs the accounting.
Cyril, so let's just move. I've got a few questions coming through. Let's just move to your next slide to get some questions around this. And you've got your issuance since COVID-19, and a big spike. And a question on this was, for example, it's clear there a big amount of that is driven by the oil and gas sector. And is that driven by COVID-19 for the oil and gas sector, or is that driven by the oil price?
Say it's a combination of both, because oil prices have come down for quite a while now. I'd say obviously things have deteriorated since for some of these companies, which makes the balance sheet measures which more necessary. You could argue that the likes of Total, for example, issued their hybrids. I think it was in 2014. So they've been quite active in the space, whilst BP only just came to the market, and the list is pretty long. We have like ENI, for example, who came to the market for the first time last week. The sector is going through some transition, which is my feeling, and they want to go through that transition balance sheet structure. So that's what's happening at the moment. I think what you see is that
the oil and gas sector is going through a transition, is what you're saying, Cyril.
Yeah.
And they're using hybrids as a means of strengthening the balance sheet to help them get through this transition.
Yeah, I mean, on the way you can look at it is you could say the oil price clearly down from where it was has created a situation. Your asset side of your balance sheet has just shrunken, right? Yeah. So you have the liabilities on the other side, which may not be calibrated in a way that they should be. So you have an overhang of debt. So what you're kind of doing with hybrids is you're really just adding a layer of equity here. So that goes into cash and then equity. But then you need to do something on the liability side So this is kind of what we've seen recently with the likes of BP, who, after issuing large-scale hybrid operation, they followed suit with what is the largest buyback of senior debt only a few weeks. So they're really right-sizing their balance sheet because the asset side has shrunken. The assets they will be operating may also evolve over time as they're changing, their focus into maybe more renewable forms of energy. So that again, is linked to an investment cycle which comes with it, and I think they want to use hybrids through that cycle rather than raising equity, which is very punitive as of today.
Yeah.
With where share prices have gone.
Thank you. It's interesting. While we're on the COVID slide, I've got an audience question on COVID here. And the question is, does having hybrid debt complicate borrowing on financing schemes offered by governments as part of their COVID-19 response?
Good question, and it's one that raised a few eyebrows. Obviously, as we saw, government schemes kick in. The one example I give is obviously Lufthansa, who has issued hybrids in the past. There was a bit of nervousness, or there is still a certain nervousness around these hybrids. I mean, these hybrids now they really traded down because of the fear that they would not be able to call them or be able to service the coupons on this bond. So that's clearly come out of that context. As Lufthansa their state support, I think there's still a big question mark, at least in my mind, around will they be able to call this instrument, or will they be able to pay coupon? Because some of these state measures obviously put some there are constraints around these state measures, right? So you wouldn't pay dividends typically in this context. Will you be able to pay your hybrid coupon? That's still up in the air, I would argue. So I guess it does not kind of hybrid issuers will be able to receive state support. What will happen with hybrid investors who own these existing hybrids? It's a more tricky question. Will really depend of the format of the state support. Whether or not the company will be able to service the coupons or refinance these hybrids when they come due.
Thank you, Cyril.
So
there's another question coming through.
There's a number of other things that you need to kind of factor in. I mean, what you also see on these hybrids is that the equity content that they get from rating agencies is only temporary. So it usually lasts for up until the first call date. Now, if your credit is deteriorating, and I'm kind of moving into the S&P criteria here, then you could get 5 years of equity credit if you slip to non-IG. So let's say you were an IG rated company like Lufthansa was before the COVID crisis. You would typically have the equity treatment with S&P up until that first call date, and at call date the instrument becomes effectively senior debt. So there's no incentive for the company to keep the instrument outstanding unless they think it's still cheap funding for them. So one would typically refinance the hybrid or call it, right? Now with Lufthansa, since they've been downgraded to non-investment, what happens is that the instrument still keeps its equity credit for another 5 years. So the incentive for the issuer to refinance the bond is not as high. So there's a high probability that when this bond becomes callable early next year, they may just choose to skip the call because they think it's pretty good capital still for them. And that obviously, changes the dynamics with on this product, in this situation.
Just keeping an eye on the time, Cyril. We've got some more questions coming through, so let's try and get some of these answered. But on the still on this COVID slide, which which talks about the popularity recently. Someone has asked, do certain countries have a greater preference towards issuing or investing in hybrids? And I think for me, I'm quite interested in, obviously as a corporate, issuing is great, but it's always interesting to understand what's driving the investor. And so, if you can respond by just talking about investor considerations and where you've seen investors being particularly interested and which countries you're issuing in because of that investor demand.
It's a tricky question. I mean, I would say, to me, it feels very similar to your senior bond investors. So anybody who's already buying your senior debt is probably going to be keen to get involved in a hybrid due to the mere fact that this is, a yield enhancing product for a credit which they already know, or they should know fairly well. The risk factors here, which are very unique to hybrids, is the risk of around the non-extension risk at the first call date, and the coupon risk, effectively. If you get comfortable with the
Cyril,
credit...
If you're seeing, Cyril, senior bond investors might be keen on this, and if senior bond investors might be pension funds and insurance companies, and correct me where I'm wrong, but they're often they've got very strict investment policies in place. Has the rating agency change in approach helped bring the investment into hybrids within investment policies at all?
I don't think that it's changed much for investors. I think it's changed a lot for issuers. One thing I can say is that there is a small bias towards a certain investor type. It's more towards, hybrids are more geared towards real money than insurance companies. We do occasionally see insurance companies put hybrids, but I think it's not always their cup of tea because of the Solvency II requirements, which make this maybe restrictive for them to participate in subordinated debt. So there's maybe a slightly lower appetite from companies on hybrids, all else being equal.
Again, I'm keeping an eye on the time. I've got time for probably about two more here, Cyril. But there's a couple of questions that have come through. With government debt levels increasing exponentially, is there a risk that corporate debt may be crowded out? And will this encourage more use of the hybrid market?
I think what we're seeing here clearly is that, with central banks buying senior bonds in grand scale, there's not much paper left for investors to get their hands on, which is providing them with a decent return. So that's created a clear pull on spreads, which have come down quite dramatically since 2016, really. And I think that's clearly helping the asset as a whole. I mean, today you can issue, hybrids, 10-year call structure at roughly 2%, which is amazing. I haven't seen that in very long time. Anybody who comes in a hybrid format, as of recently, is probably looking at the lowest ever coupon achieved in history, or what is considered cheap equity to a certain extent.
And are you seeing LIBOR reform affecting new issues and affecting the hybrid market at all?
Yeah, I mean, similar to senior bonds, right? We have to, factor in the benchmark changes in the way we structure these hybrids. So that's clearly captured in that sense. Obviously, these instruments have resets, and we need to kind of accommodate for any future change on that front.
And last question I've got here is which rating agency has been the most consistent in terms of hybrid methodology? That this person says, I presume not S&P due to what they did in 2017.
It's a fair point. I mean, clearly, there's been a lot of noise around, and one could argue that when you look at the methodology of S&P and Moody's, it's a bit conflicting. So I'd say the most consistent agency in my mind would be Moody's. They haven't changed too much, and they're very accommodative, right? So with Moody's, at least you have limited freedom in terms of buying hybrids back at any point in time, or the equity you have with that agency is basically doesn't end at the first call date. So it's a more permanent equity feature from that perspective.
Moody's. Okay, right. Cyril, I'm going to wrap up now. We've got 3 minutes left, and I'm just going to say thank you very much, Cyril, for joining us today. It's a complete privilege to have heard from an expert like yourself. And for my part, I certainly understand now that hybrid financing is a much broader and more powerful concept than I had understood previously. Going back to the theme of the conference, which is balancing risk, championing sustainable growth, whilst hybrid financing might not be for the financing of eco-friendly hybrid automobiles, as my initial research indicated, it is most certainly a tool for balancing risk and for sustainable growth, as it provides another possibility for organizations to diversify their sources of finance, reducing the risk of relying on any one source and enabling sustainable growth by increasing the pool of funding options and potentially lowering the overall WACC. Tell me if you disagree with that. But I know it's been really fascinating to hear what's been happening out there. And many of us can get locked into our own bubbles and not be too aware of the possibilities out there. So thank you so much for joining us. I'd just like to finish with asking you, Cyril, if I was a corporate treasurer in an organization that met your criteria for hybrid financing and wanted to explore this further, what would you recommend as my next steps? We've got about a minute. How and when?
Yeah, I mean, what I tend to say is that hybrids should be part of your especially if you are obviously a rated company, and you are going through some position, you are in a cyclical sector, or you are acquisitive. I think it's part of your toolbox today. Getting familiar with the ins and outs of hybrids is something I would encourage you. I mean, there are some nuances, some of which we touched on today, and it's a pretty simple, straightforward product. So again, as I said, if you're already issuing senior debt, it's just an extra layer of complexity, but you're talking to the same investors clearly. Which makes it an easy exercise to through the market, whilst an equity raising is way more punitive. You're diluting your shareholders and so forth. So that's the constraint I see on the equity side. So hybrids fit in quite nicely. They're not everybody's a cup of tea, but there's clearly scope for most large corporates to consider.
Thank you, Cyril. We're going to wrap up now. I'd have thought that maybe a corporate treasurer should potentially write a paper ruling it in or ruling it out, and perhaps they could contact you on LinkedIn or even myself, and we can point them in the right direction to get further information. Thank you to the audience. Thank you, everybody.
Thanks, James. Thank you.